If what happened this week continues, we are going to see prices go year over year negative by the end of September. Now, in this video, I'm going to share with you what I just saw, some of the drivers of prices, and then give my opinion on whether or not this will continue. So let's just start right out of the gate. What did I see? Now, the median price for closings this past week was $460,000. Now, just so you know, that's the low this year. We closed January at $460,000. Now, there's a couple of things that makes this price point interesting. First, last year we closed out September at $468,000. So yeah, if we continue to get $460,000, we would be negative by roughly 2% by the end of September. By the way, this is the dramatic drop in prices that I said would happen almost 2 months ago. It's finally starting to happen. Now, to put this in perspective, if you take the median of the last 31 days, we have $490,000. If you take the median of just August, so basically the last 3 weeks, we have $485,000. And then in the last week, it's $460,000. This is a clear downtrend in prices. But how do you know this isn't just a seasonal price drop? So every fall, prices drop. Demand is lower than what it was previously in previous months, and listings that haven't sold begin to accumulate. This naturally creates price pressure. So how can we look past seasonality to get an idea of what's not seasonal in this number? One super simple measure is price cuts. Now, how many listings have cut their price compared to last year? And when this number exceeds over 35% of active listings cutting their price, it suggests that values may have started shifting down. Now, price cuts as a percentage of active listings are at 39%. Last year at this time, it was 36%. And when we compare it by counties, we can see that certain counties like Davidson, the urban core, is much softer than Williamson or some of the other surrounding counties. Price cuts are higher than they were last year at this time, suggesting that it is a softer fall than last year, even as current median price is about 2% above where we were last year. But let's now shift and take a look at supply and demand. Supply, also known as inventory or active listings, is there more supply today than there was last year at this time? Now, for Nashville, the answer is a resounding yes. We have 21% more single-family active listings today than we did last year. Now, in certain counties like Davidson, when you include condos, that number is 40% higher than last year. Now, it's easy to say that we have more supply, but let's look at demand. You see, single-family contract volume is flat, and it's basically been flat to down for the entire year. That means even though we have 21% more in inventory across Nashville and single-family homes, demand hasn't picked up. For this, I mostly look at single-family housing, so we'll zoom in on price point and location for single-family housing. Let's start with the $1 million houses. Active listings for $1 million houses across Greater Nashville are 1,606, up 13% from last year. But contract volume is also up 13%, with 270 contracts in the last 31 days. When you take the ratio of active and contract, it's right at 6, and this is where it was last year. So even though supply is up, it's a response to demand in a much more balanced market. Even as most would define 6 months supply as a buyer's market, this is much more normal for a luxury market, and sellers tend to be less stressed and more patient when selling. There's not as much price pressure there. But let's take into consideration location. Look at Davidson versus Williamson. Even in the $1 million space, contract volume is down 15% in Davidson. In Williamson, it's up 28%. That's a massive distinction for $1 million homes. So even though we can say that demand is growing with supply, it's clear that the two different counties are showing two very different behaviors. And when we look at supply, even though Williamson's supply is up 8.7%, when comparing to the contract volume, it's clear that supply for $1 million homes is actually tighter compared to last year. In Davidson, on the other hand, it has more active listings and fewer contracts in the $1 million space. So if you're a buyer, you should be more aggressive in Davidson, and maybe in Williamson, it's going to be a little bit harder to negotiate. This is why it's so important to drill down, because there's different dynamics happening all over. Now let's contrast that with what we're seeing in the lower priced houses under $700,000. Now keep in mind, this is still 1.5 times the median price. So this is the vast majority of transactions. Active listings are at 4,502. This is up 27% versus last year's 3,525. Demand or contract volume is 1,774, down just 1% versus last year's 1,798. It's a seemingly much tighter supply, but because it's growing rapidly nonetheless, it makes for a softer dynamic. In fact, when we look at the ratio of supply and demand, inventory for lower priced houses is growing, while the inventory of $1 million listings, relatively speaking, is flat compared to last year. Now, this is why it makes sense to combine macro with micro, what's happening across Nashville with what's happening in specific neighborhoods. Look at Ladd Park, and I've mentioned this before, but in Williamson County. I told you all several months ago that it was struggling, but that the new builds surrounding it were drying up. Now, as they dry up, Ladd Park found a floor. The lows are higher and the highs are higher versus a Green Hills in Davidson County that's been trending down from last year. Price has been trending down. Contract volume has been trending down. This is a much softer area. And it makes sense that Davidson $1 million listings versus Williamson $1 million listings dynamic is playing out the way it is in these two neighborhoods. So going back to the beginning, could we see year-over-year negative prices? The answer is yes, and it could be as soon as September close. Now, while the dynamic playing out are favoring higher volume in the $1 million homes, when we look in aggregate, we are seeing not only prices drop this past week, but we're also seeing a larger gap between median list price and median sales price. This suggests that the houses that are closing are also giving up more of their price. And we are also seeing listings shoot up this week as we make another high in Greater Nashville. I believe it's possible that the National Association of Realtors settlement on buyer fees could have something to do with this. As the first week buyer agent commissions aren't offered on the MLS, we saw a pretty significant bump in active listings. Now, only time will tell. So if you are hoping for lower prices, they do seem to be trending down, and it does appear to be more than seasonal. That being said, depending on price point and location, the dynamics can be completely different. Now, I have a lot of buyers in the $1 million range waiting for distress and a drop in prices. That's just not happening. It's not found in the data right now. $1 million homes appear to be in strong financial shape and are being patient with their prices, while there seems to be more weakness as you get into the more interest rate sensitive groups. So while I personally hope that prices continue to drop, and we do in fact get a year-over-year negative, which would be awesome in my opinion, it's a bit too early to call it. The things I'm looking for to change my opinion on this are if the median contract price goes year-over-year negative, or if we continue to see the gap grow between list and sales price. So far, it's still too early to call, but if there's a strong change, we could dip into negative territory before the end of the year. And if you're shocked like me at the resiliency in prices, let's just take a stroll down memory lane and hear what someone way smarter than me once said.
As I said before, keep your eye on one thing and one thing only: how much government is spending. Because that's the true tax. Every budget is balanced. There is no such thing as an unbalanced federal budget. You're paying for it. If you're not paying for it through it in the form of explicit taxes, you're paying for it indirectly in the form of inflation or in the form of borrowing.
Thanks for watching. I'll see you next Saturday.